Now, I've been pretty open on my channel about the fact that I'm almost done buying SCHD, the Schwab US Dividend Equity ETF, for my personal portfolio, and this is not because I changed my mind about the ETF or I'm not bullish on it long term, but I just have so many shares of it, around 2,300 plus shares across my portfolios, and with the size of my personal portfolio, it's starting to get a little bit on the heavy side. And even though it's just the first few days into the new year, I already sort of cracked and I already added a few more shares of my favorite dividend growth ETF in my portfolio, like a lot of you guys have guessed, and it looks like I'm probably going to keep adding some more as time goes on. But in this video, I came across an interesting article from Seeking Alpha that I want to go through, giving multiple different, very important, crucial reasons to not stop buying SCHD, especially with where it's trading as of right now. So if you've maybe been on the fence like me, whether or not you want to add more SCHD to your portfolio, trust me, you're going to want to stick around until the end. So drop a like down below, subscribe, and let's get right into it. If you are a dividend investor who wants to level up your portfolio, you need to be tracking your dividend income consistently. And that's why I created the perfect dividend tracker that I've used to scale my dividend income up to all-time highs over the last year. Now, along with this dividend tracker, you're also going to receive my A to Z dividend investing ebook, which shows you how I personally started from $0 several years ago to now where I earn over $7,500 per month in dividends. So if you want this tracker and the ebook, go to the first link down below in my description and grab it today. So once again, this article comes from The Barnacle on Seeking Alpha, and use my code down below in my description if you want to sign up for Seeking Alpha today. So it says, do not give up on SCHD, and just because I have personally been sort of thinking about giving up on this ETF, at least with how many shares I have as of right now, I read through the article and I thought it was amazing, so I had to share with you guys. So in summary, it says, SCHD's underlying index, the Dow Jones US Dividend 100, outperforms the S&P 500 in key metrics, making it a strong buy despite recent underperformance. This ETF's data excludes critical periods like the tech bubble, the Great Recession, creating a base rate fallacy when compared to the S&P 500. Historical resilience during market downturns, including 2018, showcases SCHD's ability to generate profits and provide defense against volatility. Corrections and crashes are inevitable, but SCHD's methodology and performance history makes it a solid choice for risk-averse investors just like myself. So here's the introduction. It says, the title pretty much says it all. If you are a part of a community that believes the Schwab US Dividend Equity ETF is not an answer to every equity income question, then you need to wake up. Granted, SCHD has not performed well against the overall market, but that indicates to me that one does not know how to analyze the underlying index. In this piece, I will do that and give the supporters of SCHD an argument to support their conclusions. I will not analyze underlying constituents. This will strictly be about SCHD's performance against the S&P 500. To do that, I will study the performance of the underlying methodology, the Dow Jones US Dividend 100 Index. So then we read on. So then it says the index SCHD uses the Dow Jones US Dividend 100 Index as its underlying approach. Here's a basic outline of its methodology. So the parent index is the Dow Jones US Total Stock Market Index. Construction: focus on high dividend yielding stocks. Stocks are chosen based on fundamental strength and financial ratios, weighted by indicated annual dividend. Now, the reconstruction and rebalancing happens once a year. It's rebalanced annually. Now, as of the writing of this article, which some of these have already changed, funny enough, but here's more or less some of the top names in the ETF. Names like Cisco, names like Bristol Myers, names like the Home Depot, BlackRock, Chevron. A lot of these names are very familiar if you have held on to SCHD for a while now. Now, they then say the S&P Global has provided performance data for the DJ US Dividend 100 that began in 1999. This is important since SCHD's inception was in 2011. Here is how the index performed over the last 26 years. So then they go on to show different metrics during different market uptrends, downtrends, and how the underlying index has performed next to the S&P. Next is SCHD and the base rate fallacy. Unfortunately, SCHD data does not include during the collapse of the tech bubble. This is 2000-2002. During those 3 years, the S&P saw negative returns for each of these years. This is a unique period in history of the US stock markets. There have only been 2 other periods when the stock market saw losses for 3 consecutive years. Those periods were during 1929-32, the Great Depression, and 1882-84, the Depression. Any data regarding SCHD that does not include the tech bubble period creates a base rate fallacy by ignoring this period. To make a finer point, during 2000-2002, the S&P lost 37.59%, where the Dow Jones US Dividend 100 Index gained 24.63%. They then go on to say, in addition, base rate fallacy occurs when ignores what happened around 2008, the Great Recession, which is the second worst year on record for the US equity markets. Lastly, he says, as one can really see, SPY is a better choice than SCHD based on overall return, which is around 15% versus mid-13s. Both honestly very, very good though. More likely to generate profit, 1 versus 0.96, beating inflation, 0.89 versus 0.83, beating the risk-free ratio, 0.98 versus 0.92, and controlling downside deviation, 1.9 1.38 versus 1.35. Looking at this data, there is no compelling reason to buy SCHD. That might be a big mistake for the risk-averse investor, and flawed thinking because the inherent fallacies that exist. Lastly, the article says, my take on corrections and crashes. This is important. Since 1999, there have been 4 calendar years where the stock market saw losses greater than 10%. This was in 2001, 2002, 2008, and 2018. 2 of those years, 2002 and 2008, saw losses greater than 20%. Based on historical returns since 1793, the market will lose money about every 3 or 4 years. The market will see losses greater than 10% about every 8 or 9 years. And about every 33 years, equities will lose over 20%. The disclosures are true that there are no guaranteed of gains or losses, including principal or possible. Corrections and crashes will happen, and SCHD and its underlying index have shown resilience during these periods. The most recent example was 2018, when SCHD generates a return of 3.24%, where SPY saw a sizable loss of 14.39%. While SCHD is not a growth ETF, it does generate profits and will provide the investor with some defense against market volatility. It's a strong buy, have fun, and make some money. So I thought it was quite interesting on how he looked at SCHD compared to the SPY and broke down multiple different time periods where there's not really much to compare upon. And the longer that this ETF is trading now, it's been out for around 13 years, we're going to see more data and more reasons, in my opinion, to buy and hold on to this ETF because of its resilience and, of course, because of its dividend growth. Now, that being said, are there some ETFs across the market or even some underlying indexes that could outperform SCHD over the next 10 or 20 years? I think 100% is definitely possible, but I do think for the dividend growth investor out there that wants to earn consistent cash flow and see their cash flow grow, along with having their portfolio grow with it, SCHD is almost a perfect ETF to cross off all that. And besides that, I know so many investors compare SCHD to the S&P 500, but if you look at the last 10 or so years and use total return as a metric, they both have traded very, very similar, with sometimes SCHD being a little bit higher, some years the SPY offering a little bit more return, but over time these two have been neck and neck, which have offered investors more or less the same total return, at least over the last decade. All that to say that if you want to buy SPY or SCHD, in my personal opinion, I think they're both great opportunities to build a massive amount of wealth long term. Now, the last thing I'll say about SCHD, at least for my personal portfolio, is that if this ETF does not continue to raise their dividend consistently, like we've seen over the past several years, to the tune of around 9 to 10 to 11% dividend growth rate, then I think not only speaking for myself, but a lot of other dividend growth style investors out there, there might be better opportunities that we're looking for. But at least so far, based off of the last dividend increase alone, this ETF is still sustaining and growing their dividends consistently, which is helping us investors make more and more cash flow off the shares we already own long term. Now, as a side note, I want to hear from you guys down below. What's the main reason that you're purchasing SCHD, if of course you hold on to it? Now, with all that being said, I have one last question for you guys to comment down below. When it comes to dividend growth investing and ETF specifically, what's your #1 favorite dividend growth ETF that you've been buying consistently over the last days, months, and years? Mine has personally been SCHD, which I was planning on changing this year, but I'm already buying a few more shares here and there. Let me know down below in the comments. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.